And we are live. Good morning, everyone. Casey here from Kiwi Landing Pad, tuning in for another webinar. Today, very excited to have a good friend on the line, Tim Wixon from BNZ. Welcome, Tim.
Morning. Hi, everyone.
So it's going to be a cool session where we've got lots to talk about. But as always, very keen for you guys to ask questions and we kind of thread that in and allow us to kind of dig into the things that are most important for you. So a little bit of context as we kind of dive into things, as you've seen in the title of it, it's very much about kind of navigating assets, what that really looks like, intangible assets, all that sort of great stuff that you can be in the best position to engage and get support from BNZ. So Tim leads the tech industry for BNZ, works with, Tim is about 30 different tech-focused leaders throughout BNZ across the country. There's about 1,400 businesses specifically that fall under the category of tech within software, high-tech manufacturing, biotech, a bunch that sort of general kind of categories. With that, obviously, you see a lot from all ends of the spectrum, and what I really love about what you do, Tim, is you're a champion and ambassador for startups and businesses within your space on how they can get the most support. So really appreciate you jumping on this webinar.
Thanks, Casey. First time I've heard banking and assets and cool all on the same thread.
So a couple of things that we're riffing on, everyone, Tim and I. As kind of mentioned at the start, this is very much a safe space where you can have the conversations and ask the questions that are important before you necessarily get into the actual conversation with whoever you're talking with. Tim's going to do his very best to kind of be as transparent as you can and as helpful as you can on those different pieces. Very much here to empower you. But as mentioned, intangible assets is the key topic that Tim's about to go into. But do feel that you can ask questions and we'll kind of steer in those sorts of directions too. But without further ado, Tim, should we kick off?
Sounds good. Thanks, Casey. So I thought I would just start by framing up just a couple of the fundamentals of banking as a bit of a refresher, hopefully for this audience, and probably just to frame up a discussion that enters into assets. So just to the headline, financing from a bank, but it's also any investor requires making some form of decision to put some capital into you and your business for a form of return, right? And for a bank, it's a financing decision. For an equity investor, it's an investment decision. And for us, it's a fixed return, so limited upside. And from an equity investor, it's sky's the limit, right? So unlimited return. And so from what that means in terms of how a bank or a banker looks at any form of business, is two things become quite key, two constraints or things that we always look for every business. And one of them is cash flow, and the other one is security or collateral. And cash flow for us means that there has to be some form of cash flow available to service whatever facilities or funding we put into a business. And the security one is more the topic of today. We look first at assets, right? So except at the really top end of town, we always take what's called a general security agreement. So a first ranking security over the assets of a company, business. And then you get into the space where assets means different things. And so I guess I just wanted to launch in and just try and define a little bit of what that means. And I'm going to throw out a couple of stats and hopefully it'll make a bit of sense. But if it doesn't, just bail me up and I'll try and reframe it a different way. But I think the intangible assets definition is sort of challenging because it kind of just means not tangible. And I think tangible assets are quite easy to understand. It's things that you can see, feel, and touch. So land, plant, buildings, etc. But when you start, if you look at a definition of what an asset is, it's defined generally, and there's a few various sources you can get it from, as a resource with economic value that an entity owns or controls with the expectation it will provide a future benefit. And then a resource is pretty much anything, right? So for me, it's really about what has economic value and that future benefit idea. and that can be kind of anything. So I guess unhelpfully, the original accounting standards and assets are thought of in an accounting standard framework usually first, were developed in the 1970s. The bank codification system for how we look at businesses, and we've done a lot of work on how we identify and ring fence and define what a tech industry looks like from a bank perspective, were developed in the 1990s. The internet started in the 80s. The first SaaS companies were developed in the early 2000s, right? So later than all of those markets. And a lot's changed since even the 2000s, right? We're now 2021. But the accounting standards, the coding system, in terms of how you identify businesses and bank systems haven't really changed a whole lot. Definitely not at the pace of businesses. And now you get by various sources a world where when the accounting standards were first created, most assets were intangible and the value of businesses was pretty tangible. And most businesses, like book value of assets, was pretty similar to the value of a company. And now it's by most estimates, it's more than 80% intangible, so not tangibly based. And so it's a massive swing, right? And we're doing, and we're still on a learning curve as a bank, but we're doing our best to keep up, and it becomes pretty important, right? And so if I think about intangible assets as not being tangible, then you start to get into, well, what are they? And sometimes it's easier to think about things in terms of, what are your unique value propositions? What are your unique points of difference? What are your areas of defensibility? And you can start to list off a whole bunch of options that sit within them. It could be your source code, your databases, data, domains, brand, customer relationships, contracts, some know-how. It's kind of anything. And so I guess if you think about back to that original framing, from a bank perspective, we look at that cash flow and the assets or the security as our primary source of repayment for or financing of our facilities and interest and cost. And assets is your kind of secondary, or what happens if things don't go so well. For example, bankers tend to look at a downside and upside scenario, go figure. And so it's really, what are those unique things that you have that have value that you could realize for a sale or investment coming in or whatever it is later on. We're not so focused on the actual value of them. Most of that's, and all valuation tends to end up being realized by pretty simple I guess, to and fro. It's really what someone's willing to sell something for and what someone is willing to buy it for, right? And you get an agreed valuation and price. But we are pretty focused on that there is that something there, so that those assets. So that's probably a bit of an intro on it, and I guess just to differentiate again, I just want to dwell on this just for a moment, but. So intangible assets are recognised because they're not tangible, and it's that economic value idea. Intellectual property rights are one form only. So patents, trademarks, registered designs, plant variety rights, copyrights. Those are things that are quite identifiable and registerable. And I'm not thinking about it on a balance sheet. Most of the value sits off a balance sheet. And that's something we've been adapting to for quite a long time, right? Most banking systems are set off accounting and financial statements, but most of the value sits somewhere outside of those generally. And it's not just tech businesses; it applies across a whole range of different industry. But it's definitely acute for tech company or tech business models.
And Tim, what would you say in regards to, so you've got cash flows primary, you've got assets as your secondary or collateral for the downside side of things. Is there a ratio that's usually expected? Because obviously, I guess like from a startup's perspective, cash flow might be in the early days and kind of trying to ramp up, and they're doubling down on investing into actually building things for how they scale. So cash flow might not be looking great. So that's obviously why this is so important, right? Is how do you balance that equation with the assets, be it some being intangible? Is there a ratio expected, or is it okay for it to be lopsided?
Yeah, it's a good question. So I might just wind back on a couple of things that you picked up on there. So I mean, there's some really fundamental things that we always look for. Like character is a go no go. It's probably the only go no go. And cash flow definitely means that you don't have cash flow if you don't have revenue, right? So pre-revenue is definitely not a banker space. Then there's always the assumption that cash flow means something like net profit or some sort of accounting measure. And I guess it's worth pointing out that banks don't fund loss-making businesses as a rule, and by exception, we look at loss-making in an accounting sense. Tech companies would be the only area that we really look at businesses that don't make a net profit. But it's a bit of a misnomer that banks need to fund only loss-making companies. There's a vast majority of our client base in tech make some form of profit. But we also look in terms of the ones that we've got financing into. But we also look at cash flow in terms of so definitely revenue. Then we look at drivers in terms of how much are you spending on customer acquisition, for example, and how's that translating into revenue. So some of those core unit economics and also how profitable is the New Zealand market versus some of your offshore activity if you're into international markets. How much are you spending on discretionary projects that are kind of future bolt-ons or offerings that maybe are things that you can speed up and slow down. So some of those are kind of what levers have you got to pull to realize some cash flow if you had to. And then I just want to, that's one little thread off what you've said, to use your turn of phrase, Casey. The other is the cash flow bit. The other is that banking has probably changed over time, and it's evolved, and certainly in my career in BNZ, from being probably a little bit more security focused to quite a lot more cash flows focused. And actually those settings have made it way more possible to start to build up an offering into tech companies. So if you started off where it's a bit more security led, and security just means asset led, and asset led just means tangible assets. Very hard to get your head around putting financing into tech companies. If you flip that on its head and you go, okay, cool, well, we'll start with cash flow. Then cash flow drivers of many tech business models, not all, there's a lot of complexity in some, are relatively simple compared to lots of other business models. And so the actual cash flow side is easier, and then you start looking at the asset side as a secondary thing, and that's why I've expressed it as the second part. But that's not just banking as well. I mean, if you talk to investors, they'll be super interested in unique points of difference and what measures you've put around those to protect and to make sure that you own the value, that all the hard work and everything, you own the value that you're creating. So going back to that economic value concept. And so I think it's quite important. I think it's so from a bank perspective, if you still go back to that idea that we take always take that first ranking security over assets, the onus is on us to understand those a lot better. And I said to Casey before the call, I'm a bit like a broken record on this, because selfishly from our perspective, it makes a whole lot more businesses really fundable, the more sophisticated and the more thought that's going into to what those unique points of difference are that you're capturing and building, and what your key value drivers are, and that you own them, because that builds that ability to have both your cash flow and your assets, if that makes sense. But it's the same. It doesn't matter if it's us or another form of capital that comes in. Everyone's interested in this side of things. And certainly when you go for if you're going for a big sale or an offshore purchaser coming, equity player coming in, they'll be pretty focused on it as well. So I think it's a big opportunity to create more value or show more value. And then I guess I might just express what my thoughts are on best practice on it as well. And I'm super happy to be challenged, because this is just one person's viewpoint from a bank perspective of what helps in our world. But I think there's the best businesses we see that come and approach us, and that we talk to, and where we get the best amount of financing, and putting aside the cash flow piece, and I'm happy to talk to that in more detail. Are ones that are really clear on where the key value drivers are in the business. Even better if you've got a bit of a schedule, or you've gone through an identification process of where your key points of difference are, and where those unique elements are within your business. So we're probably the best operators will do the identification piece, and then best practice, in my view, is that you've thought about some measures to make sure that and can prove that you own those unique points of difference or areas of defensibility, and that you've taken some measures to create barriers or protections around those. And those come in lots of forms, and that's quite a deep topic as well.
Okay, cool. And we've got a question that's come through from Ken. Thank you for your question, Ken, which is, we're making a profit and cash flow positive and a nice amount of cash in the bank, but if we wanted to borrow a large lump to accelerate our growth, and as a result of acceleration, our profit and cash flow will be negative for a period of time as expected, as we will grow through to step function of growth and cost, how fast do we need to return to free cash flow to service the loan? And is there an ideal period for BNZ?
It's a great question. It's actually right on point as well. So I will give a few things on that, and then please press me, Casey, or it was Ken, was it?
Ken.
Yeah, Ken. Please press if I haven't answered the question well. We're always aware of this. So one of the interesting things in the accounting standards, if you're spending on growth or customer acquisition cost, or some of those things that add a whole lot of value to a business, all get expensed through a profit and loss, and there's no visible value that's created from any accounting frameworks off the back of it. Usually just future revenue at some point in time. So two things there that you've picked on, which is a bit of the art of how you do the financing side, right? One of them is so always good start point to be past break even. It's a bit of a sliding scale a little bit. So if we put, and the other irony is, if we put financing in to fund the growth, then you're using our facilities to go and expense it through a profit and loss, conceivably, and we're funding to create that scenario that you've put forward as well. So we will look at that, and we'll look at the underlying profitability of your existing customer base. We get pretty focused on what the use of funds is. So what are you going to spend on, and what's it going to return? There are some limitations for us in terms of our risk reward trade-off. So if you're going to push the pedal down really, really hard for quite a long time, we will struggle to do all of the financing, although we may be able to do some of it. If it's more measured, and there's some points that we can kind of measure as things go forward, we could potentially drip feed, and you prove that you spend this and it gets to this, and you spend this and you get to this, and you can progressively draw something down, which is quite a nice way to structure things without getting too complex. The break-even point, I don't think we've formed a really strong view, because a lot of it depends on how fast top-line revenue grows and how large your gross profit margin is. And, if you're in SaaS or as an example, what your ratio of lifetime value to customer acquisition cost looks like. And, and does that improve if you spend, call it, say it's $2 million. If you spend $2 million, does that improve your ratios and your unit economics or not? And has it been spent well and executed on well? If it's within the same financial year, it's a lot easier. If it's in the next financial year, it's possible. If it's in the one after, it's probably not for us. And if you think about how business financing works, we take a maximum term generally of about 5 years, And so, and quite often in tech businesses, it's really a 3-year term would be the most common on it. So that's the term of a facility. You don't necessarily have to pay everything back within that 3-year period, but that's the kind of lens. So, it doesn't make sense for us if you're in a cash burn or loss-making mode for the full 3 years of the term of a facility. There's not a lot we can show that that gives you free cash flow or cash flow available to pay us down, if that makes sense. So that's kind of that's a bit of the logic on it. It's probably not a really straight answer.
Just some extra context that's come through, Tim,
Yep.
that Ken just shared. I should add we are a SaaS business and it's primarily for dev projects and customer acquisition. The CAC payback is 1.5 months, LTV CAC is 7.1. I don't know if that changes your thinking, Tim, or adds any extra lenses.
That's pretty strong, Ken. So yeah, we'd probably look at that. It's like 1.5 months payback's pretty fast. Very
sweet. Thanks for the question, Ken. Keep them flowing, everyone. So we've got another question that's come through from Grant. So how invested is BNZ in developing relationships with potential customers, i.e. the planning stage requires discussions prior to the execution of plan?
Yeah, Max, you're right. That's a cash printing machine, I agree. But we don't see too many 1.5 month payback periods. It's I can say that across quite a large portfolio. Sorry, Casey, I got distracted by that. It's
Yeah, it's all good. Grant's question was how invested are BNZ in the developing of relationships with potential customers, specifically like the planning stage that requires discussion prior to the execution?
Yeah, so I'll give you two answers. There's always time constraints for everybody, right? But that is the fun part of banking. So the most fun part of banking is I'll say we don't give advice as such, but we can be a pretty good sounding board. We're very vested in like long-term success of client base because which is totally aligned with what we want to do as a bank, right? We get long, same as you guys, good strong lifetime value of our customer base as well, and as the easiest ones for us, and same if you've got a good client base, is growing your existing clients, right? Everyone kind of wins from that. So one of the most enjoyable parts of banking has been part of those earlier discussions and a bit of a soundboard and a bit of a cool that kind of those kind of movements or plans kind of align with stuff that we can be supportive of, and or those ones maybe don't, or it depends what you're doing. But quite often we might be chatting about something like building an offshore sales force, and there's options to acquire teams or hire teams, and there's different complexions of those, or businesses are thinking about what they make as core competencies and what they maybe outsource, and those all have quite sort of slightly different complexions for what it looks like from a financing perspective. And so I guess the best thing we can do is, and the last one probably I'd just comment on is, and bankers will have a bit of a risk hat on and a bit of a banker lens as well. And it's not one of the best uses that clients use bankers for is just to sound out, what do you see that's got some risk elements from with your banker hat on, and what do you think? What do you see as being easy or harder for banks to support? Probably like a couple of those questions as well. It's not a bad thing to ask. Most people don't do it, and it's kind of like what we're trying to do here. Is you got to make it a bit of a safe environment to just have a bit more of that conversation as well, both sides.
And I guess that's the thing, right? Is like it's natural, like through the journey of a business, to have certain pieces where your shit's not together, or there's a particular element you haven't thought through, or there's a gap that you haven't got to yet. And what's important is to get ahead of it, identify what it is, so you can do something about it, so then you're in a position to move forward.
Yeah, so actually, I mean, that raises a really good point, Casey. Like banks don't like surprises. So early steers or early comms is good. It gives us a chance to work together.
So, and I guess the challenge of that though is it's almost the mindset of getting in that you're genuinely on the same team and you want to work on finding the right solution for that situation, opposed to there's the other way of doing it, which is the wrong way that sometimes can happen, is you feel as a founder, I need to get these facilities because I've got all these different pressures on me, so I feel like I need to almost like shoehorn into the process to get the facilities or whatever that you need. But you're much better to actually say, hey, this is where we are. How can we make this work?
Yeah, agree.
We've got other questions coming through. So thank you for the questions, everyone. Keep them flowing. Max, you've got a question which is, what interest rates would a SaaS business get with no tangible securities?
So I'm going to tell a long story here, and you can challenge me on whether it's a cop out. I will give you some ranges off the back of it. But it's one of these things that's useful to understand, and it's actually why I wrote a bit of a first article around some of the challenges of banking intangible style, or if you call it low tangible asset style businesses. So just at a headline, the bank's pricing works something like this, and I'm going to simplify it, so it's not going to be super perfect, but here's a really high level version of it. For every facility we put in place, the bank has to allocate X amount of capital as a reserve, and we need, as our business model is to make some form of return, like a threshold return on that capital that's allocated to your loan, and we make that return based on fees, interest rate, and I'm trying to think if there's anything else. It's generally those two things. If I've missed something, someone I'm sure will bail me up. But and so how do we generate that amount of capital? It's not even across all those reserves we have to hold. It's not even across every single loan. Actually, it's dictated by some bank models, right? And I told you how long ago that some of those bank models were created. And my understanding is that there's some regulatory stuff and some of it's offshore as well in terms of what we can do in terms of updating some of those. And so there's two things that we model through. One of them is called a customer rating, and that sits on a scale from something like 1 to 23. And that customer rating score is basically a probability of default proxy, and it's based off financial statements and some qualitative questions and answers, like how long have you been in business and quality of the people and management team, etc. Yeah, and it's a bit like those Standard & Poor's or Moody's ratings, but obviously gets below that kind of investment grade, and it's all private through bank model. On the other side, there's also okay, cool, what happens in a default scenario? So we've got probability of default here. What happens in a default scenario? And that's an asset-based question. So you're getting back to those couple of comments I made in terms of cash flow on the asset side as well. And that's based on, at this stage in life, tangible security. And so a good reason why, say, housing is cheaper generally than business debt is because that's a nice tangible bit of security. Yeah, there's some other stuff in there as well, but in the simple terms. And so that rate's on a scale of A to J. It is from a BNZ perspective, and those two things combined generate a percentage of that reserve requirement, and it can in some cases it's more than the amount of capital that you put in. So sometimes if you put say $100,000 loan or a $1 million loan, you have to hold more capital, I think, than actually what the loan size is, and sometimes it's a lot less, right? And so the reserve requirements reduce effectively the better you are on those two rating scores. So 1A is outstanding, right, and 23J is not, in terms of those metrics. And so if you think about what happens with a tech business, it's not set up particularly easily, right? So on the tangible security side, you're at the bottom of the scale automatically, so that doesn't help. And on the financial statement side, if all of your assets are off balance sheet, well, it doesn't look so good from an equity position, is one of the drivers of that probability of default. And also you might be expensing a whole bunch of stuff that, I'll use an example. So say if you bought a bit of machinery, that would go straight onto your balance sheet. If you build an app, you expense it through your profit and loss. And so you get a double whammy, right? Like your cash flow on this probability of default looks worse than it would if you bought a bit of machinery. and also your retained earnings look low because you're expensing it through the profit and loss as well, so your equity position suffers. And so in a like-for-like scenario, you could spend, say, $1 million on a piece of machinery, or $1 million on the app, and they both might generate exactly the same amount of cash flows, but the treatment's different from an accounting perspective and also from a model perspective. So what that means is that tech business funding tends to be inherently more expensive than anything that's got really high amounts of tangible assets. And so sometimes, for example, in property, debt then tends to be a bit cheaper than business debt as well. So that's the start point. One of the good things about that business finance scheme is that it kind of leveled that playing field, right? It was kind of a set interest rate percentage across the board. So it didn't matter if you're a tech business or a high tangible asset business. You got quite similar interest rates, and BNZ's released this new Good to Grow scheme, which has a bit of benefit along those side lines as well. So if the business finance scheme was around that kind of 2.5%, don't hold me to exactly that range, and the Good to Grow is a little bit higher again, and then anywhere between probably, I don't know, at the top end of tech might be somewhere in the 4s, and at the earlier stage might be somewhere in the, I don't know, 5 to 8, 9% probably is a bit of a range. Just depends. And it is genuinely calculated off the back of that, which is why I've delved down that pathway. It genuinely depends on how you come out on that rating score system. And I guess the last thing is we play a bit, well, we've got some methodologies around some of those unit economics to help support that probability of default metric, because it's not always accurately captured through the financial statements. Does that kind of answer the question? Sorry, a bit of a long answer, but it hopefully gives a little bit of a flavour for how it works.
Personally, I found it quite helpful from like the context of how you land on things and thinking behind it. But of course, if anyone in the community wants us to unpack that more, let us know, and Tim will. Excellent explanation from Max. Tim, we've got another involved example if you're keen to give it a nudge. And then after that we'll shoot to the question from
just start approving stuff on the call.
And then I'm also just looking at some of the comments from Grant and Steve regarding the challenge around partners being willing to get involved on the collateral side of things, and having assets on the line. Obviously always a challenge there. So question from Robert Bell. Thanks for your question, Robert. So it is, we're a software company with really solid profits, growth, and a client base, more than 2,000 clients, generating more than 3 million a year, growing 38% annually for many years.
Nice.
But we offer payment systems. Can BNZ help fintechs? Yet how do we help the bank's compliance department to see through KYC risk? We've never been a BNZ customer.
This is a great question. So I don't have a full answer for you, and at the risk of setting myself up for some stuff to do internally, I am trying. Oh, I know your customer.
KYC?
Know your customer. So I'll give a bit of a fluffy answer because it's on my desk to try and do something with this fintech world. So a couple of things there. Well done in terms of getting to where you are for a start. It's awesome. The payment side is hard, right? And the irony is that we're kind of a fintech company as well, or becoming one. We're in finance, and we have tons of tech product offerings. Effectively, everything's software based. So the fintech space for us, and we work with fintechs in a range of ways. So I might just express that as a start because it shows a bit of the complexity. So we've got our API or open banking or whatever you want to call it, framework that's started to get released, and so there's and some of that will dip into the payment space as well and make some things available progressively over time. We also we compete with some fintechs, so there's that element to it. We are a customer of some fintechs, so there's that element. We provide some services that are getting disrupted by fintechs, so that competitive element, but also we collaborate with fintechs that solve some of the stuff effectively for our clients that perhaps we can't or shouldn't. And what have I missed there? And then there's the client side. So one of the and I had it explained to me actually by an early stage fintech that's working through our API framework in quite a nice way. Like the willingness, I think, I'll cave this as my opinion rather than the bank's, just in case there's divergent views. But I think one of the things that's challenging is the upstream stuff. So when you talk about the know your customer side, there's that regulatory side for a bank is kind of your stay in business, and so you need to meet all of your regulatory requirements to have the right to maintain your banking license, and it's also a responsibility to all the rest of your client base to make sure that you behave in that way. So that's your kind of start point. Then there's the competitive elements, and also the inevitability of getting disrupted in certain areas as well. And so if there is grey areas on that regulatory or know your customer side, it's quite challenging, because then there's, do you take a risk where you might make X dollars of return, and it's not a whole lot in many cases, by taking a client on board with a downside potential of a huge blowout on the regulatory side. So there's the kind of that element going on. The other part is that it's a little bit grey in some places, and I'm not super deep in the regulation, but as to what responsibilities sit with a client and what responsibilities sit with a bank, and which ones kind of sit with both. And so that complexity is something that I'm just kind of putting my head above the parapet internally to try and pull together under this tech industry banner that I work on. And there's quite, and the reason I expressed all those different elements, then you've got your kind of regulatory and know your customer or anti-money laundering team. There's quite a lot of stakeholders that you've got to pull together. And I think the best way that we could do it is just work out really openly where are the kind of safe zones where it's black and white in terms of that regulatory piece. Hopefully some of the regulation will get clearer in some of those more grey areas, and then also just getting clear on where are the I guess I call it the safe zones, or the appropriate zones for us to play. The willingness is definitely there. Like the API guys are furiously opening things up to do the practical stuff. The client side's just got a bit of complexity, so it's still a bit case by case rather than being able to give you a bit of a wholesale view. So sorry, I'm not sure if I've given a really good answer there. It's just there's just a bit of complexity in there. The willingness is there, and I'm keen to try and resolve a bit of the stuff internally. Just time and getting all the people together.
Cool. So Robert's just said, thanks, Tim. When time's right, he'd love to have a phone call with you. So perhaps I'll connect you guys after this for when the time's right.
Yeah, and probably like last comment, just if you've got some views on how we should think about it, I'm all ears. As I said, the willingness is there. It's just trying to make sure we've got a clear picture, and also that everyone understands some of those upstream things that make things challenging. So
cool. From Grant, how do you define a tech company from a BNZ perspective?
Good question. So the tech industry remit, we've kind of just borrowed the technology investment definition to an extent, mainly because it's been well voiced and identified in the market, and it doesn't make sense to try and to push a different framing out. So for us, it is really that software enabled high tech manufacturing and biotech. So that's your kind of core side, but also more and more so a lot of I guess I call them the mid-market telco type businesses start to play in the same sort of space. So if you think about some of the infrastructure that everyone sits on, and some of those business models end up being kind of similar. So the thing that unifies all those industries for me is that just the balance of that intangible versus tangible asset mix is just so skewed towards intangibles, and also the business models tend to be pretty unique. So it's not like subscription models haven't existed in other industries before, but some of those technology-based business models, and biotech's kind of similar, but probably one that we need to understand a bit more about as well. Just, you're building a whole lot of value, probably ahead of when you get the cash flow coming in. It's probably the most challenging one for us to tend into. But it is those sort of four main categories and a bit of that telco space.
Cool. And circling back to Paul's question, which I missed, sorry, Paul. Do you think New Zealand could ever have a Silicon Bank like the one in Silicon Valley? Is BNZ interested in this space?
Yeah, so I'm hoping that's what we're becoming, without having to call ourselves something different. So to give it's sort of for us to in some ways differentiating gets kind of interesting. I might just give a couple of answers there. I mean, so we're 6 or 7 years into
So
actively.
could we possibly, sorry to interrupt, start by maybe unpacking what that would even look like a Silicon Bank compared to a standard bank, for those that may not be in the know?
Do you want me to give my best or?
Yes, please.
So Silicon Valley Bank. So this is only my understanding. So I'll just do a couple of quick differentiators. So Silicon Valley Bank has a slightly different regulatory framework. Quite a bit of their approach is to, and they're really well intertwined with some of the investor base of the businesses that they back, is my understanding. So they might invest or own, I guess, units or invest through venture capital businesses, and then they also do some debt funding on the client side alongside that as well. So put in financing into tech companies. We compete and have competed against Silicon Valley Bank on transactions for businesses that are trading up in the US as well, on more than a handful of occasions. To give you a bit of a sense of that, and I probably see them as our biggest competition, or somewhere we should benchmark ourselves against. Mainly because we've genuinely competed. From some of the just core customer-facing technology, I understand ours is as good as anyone just for the day-to-day stuff. I think the differentiator that they have or they do that's more challenging for us, and you can think about whether this is good or bad, is a lot of their work is backing or through having influence or levers around the investor side. Ours is all pure due diligence on companies and the people. The investor side, definitely, we consider that it's a big part of our analysis as well. Both character and track record are super important, and you can imagine we work pretty closely with our family office and progressively with the JBWare guys, who are part of the National Australia Bank and BNZ umbrella, on understanding some of those relationships as well. But ours is we really do have to diligence the business. We won't just take a view on the investor, and for me that's a nice way to do it. The other thing I think they do really well is that community side around founders and tech businesses, and I'm hoping we just collaborate more and more with Casey and the team to resolve that. I mean, they're awesome at that side of things. I'm not sure that we need to reinvent the wheel as a bank. I think the relationship with those guys can work really well for that side of things. I might have missed something else, Paul, but I guess the other thing we haven't got is just quite as much. If we started 6 or 7 years ago, we probably don't have quite as much longevity in the tech industry yet, and we're learning as we go.
Cool. Thanks for unpacking that, Tim. We've got a follow-on, just circling back a little bit to differentiators between tech and now fintech. So the difference between tech and fintech if your revenue model is a share of the customer's revenue, is that typically the model behind fintech? Question from Ken.
Or so back to those comments I made before, we're framing up those safe zones and things. There's finance and there's tech that services finance type businesses, and there's tech companies that are more in the payment space. There's you know, and then there's all the other stuff like crypto and you know, businesses that do digital wallets, and it's a pretty convoluted space. I think, you know, we've played a lot in the payment space historically, and we've played a lot in the finance space historically, and we've played selectively in the spectrum in between. But there's sort of no one model fits all. We see so many different businesses along that scale, which is part of the challenge. It's really hard to just put businesses in a bucket, but most have something unique that they're doing. Fintech is like farming, sheep, beef, and dairy. Cool. I'm not sure if I can add to that.
It's cool. We've got another one that's come through from Max. What loan application processing time should a BNZ business customer expect? How much paperwork can we just give you access to our Xero and let you figure out everything you need to know?
So how does that work for when you go and approach an equity investor? So I think the comment there is, so the short answer is it's not as simple as just Xero, and probably it's not a great idea to do that for all the reasons I expressed. Like the unit economics aren't really captured in your financial statements, so you'd be doing yourself a disservice as a start point, right? So, so I don't apologise for being pretty demanding on if you want a loan and you want it done well. I don't apologise for asking for quite a lot of information. The best businesses and the ones that get the best out of us are pretty open. Sometimes it's just a lot of businesses actually these days are running a data room that they keep for all stakeholders and investors, and just do permitted sharing. That works pretty well. We're comfortable digging around in those. You know, some of the basic stuff will be the last couple of years financials and your forecast, and obviously the biases towards the forecasting. If you want a real amount of funding, it's a three-way model of cash flow, performance and balance sheet, or profit and loss and balance sheet. But more importantly, you know, what's your plans? What have you written down? What are your goals for the business? What do you track? Where's your intangible asset base? You know, where are those unique points of difference? You know, where are you on your journey? What's your capital strategy? How do we fit into that? All sorts of stuff, right? So it's more about the important stuff. The financials are part of the core because a lot of our systems and things run off those. But yeah, it just depends. And then also, if we're pushing the boundaries, then it's more information, right? You have to get deeper into that stuff, and if it's really easy or simple, then it's less. So it really depends on business model. I think our usual, I guess I call it a laundry list of information requests or standard due diligence is probably, I think probably 6 or 7 bullet points worth of stuff, big topics.
Cool. A question that goes towards kind of data side of things from Ken.
Yep.
Data room best practices. Is this just Google Drive for Docs? And I guess maybe building on that, do you see particular types of startups or examples where the way they handle their data security is significantly more important than other businesses that you'd facilitate?
So that's quite interesting. So, I mean, I'll probably actually throw that back to the audience almost. We don't see a single way of businesses doing things per se. I don't think there is a really uniform way of doing it, and I'm not sure if I'm the best place to comment. So the transparency of information is the important part for us. We're kind of agnostic to how it comes in. we from a bank perspective, everything's held really confidentially, and there's a lot of security parameters around what we push back out. So to give you an example, we don't have any way of ironically putting stuff into some of those cloud drives, etc. yet. Hopefully there'll be some way of doing so. So I think until we choose to do something from our perspective, it's hard to be hypocritical to comment and say that one or other is the best option. But it was more just to give that sense of that like we kind of look at things in a similar way to any investor, and then we make that risk reward decision, and fundamentally, does the industry stack up, and the business model and the people, those are really important. And then you kind of get to that point, is your business investable / financeable? I'll probably say. And then what does it look like from a bank risk reward trade-off? Does it kind of fit? Because I kind of think if the business and people don't fundamentally stack up, it probably shouldn't be investable or financeable. And then, but if it does all stack up, there should be some way to put some amount of finance in, whether it's $1 or $10 or 100 million.
Sweet. Okay. Tim, just as we look to wrap up, curious, what is getting you excited in the tech space at the moment?
Yeah, so I'll give two answers. I think I'm kind of excited with what I'm seeing in New Zealand. Just the scale of businesses and how they're going, and some of the growth, and I think just the perception change that's happened over the last 12 months has been kind of I think a little bit of a tipping point in the New Zealand environment. But I'm fascinated by artificial intelligence and in that space. I think I gave the same answer last time, but just there's this interesting session I did actually with Auckland Unlimited last week, which I wasn't aware of and should have been, but that Auckland was the 4th most diverse city in the world, which is kind of interesting, because when we travelled up to Toronto and had a look at their artificial intelligence value proposition, it was really around the diversity of the talent, and so feels like a big opportunity as the tech industry here employs more and more people, I hope. And we make it easier to do so. There you go. It was Rohan's stat actually. So I just think that presents quite an interesting opportunity. But I think the other one that I'm kind of excited about is that if you're in something that's cloud-based, and we've been really good at business to enterprise sales, just the scale of potential cloud adoption globally, and what that might mean for businesses that are playing in that world with digital offerings gets pretty interesting, right? If New Zealand economy is 95 or 97% SME, and it looks kind of similar in other economies globally, it just feels like there's a big wave of potential clients for everybody out of New Zealand. So I think it's kind of interesting. So.
Cool. Definitely exciting times, and there's definitely been a big shift. I'm so excited for what's going to come forth over the next kind of couple of years with the New Zealand scene. It's also really interesting the amount of startups now that are planning in the long term to stay based in New Zealand and go global while being in New Zealand. I can't speak to the same level of kind of experience with obviously joining Kiwi and NFAD about the same time COVID hit, so my experience doesn't kind of extend as much to when a lot were wanting to move to SF and that sort of thing. Obviously, there's still a bunch of founders and stuff wanting to do that. But New Zealand feels like it's in a really, really strong space. And even with like the premiere for the Outside the Valley movie we were just doing, it kind of captured a bunch of different countries around the world. And of course biased, but it felt that New Zealand held a damn strong position as a place of innovation and a place to do business. That's fun times. Tim, final thing, do you have any parting thoughts that you'd leave with the community?
No, I think probably just at a general level, like we're quite far into a journey as a bank in this area, but we're still learning. So like, feedback's always welcome. we're really trying to do our best to give a bit back in terms of transparency, because I know it's not that easy, and definitely not historically. Actually finding the right people in a bank, but also just understanding how they operate. And so the opportunity to co-learn's pretty amazing. I just see all this talent and capital in the bank that could be applied to an industry that's pretty exciting, I reckon, for NZ. So always happy to take good, bad, and indifferent feedback. And sometimes there's stuff we can improve on, and sometimes it's stuff we can communicate about better. And it's pretty genuine, right? Like the more we learn, the more hopefully we can put some capital in, and apply a bit of connectivity and whatever else from our side. So yeah, just reach out. I'll work with an offsider, Charlie, as well, if you've got any feedback. Probably most importantly, we can work with that. And yeah, wish you guys all the best, and thanks for tuning in, and hopefully I've covered off a few things of use on the call.
Tim, thank you so much for joining us, unpacking everything in a way that even I was able to understand. I've put your LinkedIn in the chat, so if anyone wants to get in touch directly, but also feel free, you can drop me a line, I can put you in touch as well. But thank you everyone for joining. Enjoy the day ahead and the long weekend coming up, and we'll talk soon.
Thanks very much. Appreciate the opportunity, and thanks all.